We are going to talk about the One Big Beautiful Bill Act. I'm sure most of us by now have heard about this. It is legislation that passed in 2025. And while it encompasses a ton of stuff, what we're focused on is the tax implications for, everyday Americans and what changed there. And a lot of us have probably heard One Big Beautiful Bill Act, and we've seen headlines like no tax on overtime, no tax on tips, new senior deduction, car loan interest is back. I've read all of these headlines or something similar. So I want to talk about what this actually means because it's never as simple as the headline tells you it is, right? So these ones we're talking about today that I want to focus on are ones that are reported on what is now a new schedule. It's a new schedule called the Schedule 1A. It's a part of your personal tax return. It is a new schedule, not to be confused with the Schedule A for those of you that itemize. It is a new schedule outside of that. It houses these new deductions that are a part of the One Big Beautiful Bill Act, and Schedule 1A applies whether you itemize or not. Okay, so whether you take the standard deduction or you itemize, you can still benefit from Schedule 1A deductions. But you guys, the thing to remember is that it is not automatic. These are not deductions that you automatically get because you did a thing or you qualified. It's also important to understand that most of these deductions are income tested and they have phase outs as your income increases, and they have document requirements. So the headlines made it sound simple, but the tax code is never simple. It's never as simple as you think it should be or you want it to be. It's always got caveats and, loopholes and complexity. So we want to make sure that we understand that these new deductions only work when you actually qualify for them, if your income falls within a certain threshold, and if you can prove the underlying income correctly. So Schedule 1A is not about what you heard on social media. It's not about the headlines you read. It's about what you can substantiate and what you report on your tax return. And I want to instill in you guys that financially disciplined people, they don't rely on headlines. They might use that to question and say, hey, this is interesting, might apply to me, let me learn some more. But they don't rely on headlines. They rely on facts and documentation. And that's what we're here to talk about. So the first part of the One Big Beautiful Bill Act, specific to this new Schedule 1A that we want to talk about, is no tax on overtime. So that's the headline that was going around. That's the phrase we heard. And that is the simplified version. There is an exemption for your overtime from income tax. But let's talk about what that actually means. And let's talk about some limitations or some thresholds that might exist that might make this not as exciting as we thought it was. And for a lot of people, guys, it's still going to be great. It's still going to be a huge benefit. But for some people, it's just not going to be as big of a benefit as we had hoped. So let's talk about this and find out why. So first thing is that I want to remind you is that this deduction is only from income tax. All right, your income, your W-2 income from overtime was still subject to payroll taxes. FICA, Social Security, Medicare, that all happened on your W-2. That happened. That's what they take out of each payroll. That's not what this applies to. This is an income tax. So your federal withholding, that's what this applies to. And so it applies to just your income tax. It's part of what this new Schedule 1A, it's going to be a deduction that gets reported on this new Schedule 1A. But what we want to talk about is that it does not eliminate tax on all of your overtime. And this is where a lot of people are getting stuck, or they're feeling bamboozled or slighted. All right. So let's use an example. Let's say I make $20 an hour normally. So my overtime rate is time and a half. So that's $30 an hour. Normal rate, $20 an hour. Overtime rate, $30 an hour. However, when they talk about the overtime premium, being the amount of overtime wages that qualifies for this deduction, they're only talking about the additional pay. Okay, so we say time and a half, they're talking about the and a half. So in my example, $20 standard rate, $30 overtime rate, we're talking about that $10 an hour difference. That is the amount that is subject or qualifies for this overtime premium. So that is the first thing that kind of gets people stuck is they're like, oh my gosh, I had $1,000 of overtime last year. Well, no, I mean, you did, but not all of that is going to be part of this, is going to qualify for this deduction. Okay, the other part is this is limited to $25,000, meaning essentially you'd have to have $75,000 of overtime pay on your W-2, right? Because only the and a half qualifies for you to meet this threshold. But for some people, that does happen, right? So there is a limit. 25,000 is the most that you can take as on this deduction line item. All right, but we want to talk specifically about how do you find this? How do you calculate this number? How do you know what this number is? And that's tough for 2025 because the IRS and the Treasury did not set a mandate or a requirement for employers on how they report this. So they just said, do your best. What we're finding is most overtime that qualifies, these overtime premiums, are being reported in box 14 of your W-2. Using a code, we've seen OT Prem for premium. We've seen OT Time. We've seen OTT. So the code, there is no standard code, but if you look at your W-2 and you look in box 14 and you see some OT something amount, that is the overtime premium amount that your employer has calculated for you to use in qualifying for this deduction. And if you have that, you are good. There's no further action for you to handle. You take that number and that's what we're going to use. If there is no number in that box 14, but you know you worked overtime, the next option that employers had was to provide an overtime summary report. What does this look like? No idea. We have not had any clients that have had this yet. But if it is not on box 14 of your W-2 and you receive an overtime summary from your employer, that number in that overtime summary can be used to calculate this deduction. If there's nothing in box 14 of W-2, don't receive an overtime summary report, but you know you had overtime, the right thing to do is tell your employer you need a statement. That was required for them to do. But if for some reason you cannot get this from your employer, one thing we've seen circulating in accounting forums is using your year-end pay stub to kind of back into your premium amount. But there's going to be a lot of math and work done there, right? Because our year-end payroll or our year-end pay stub gives us all of our overtime, not just what qualifies, right? So it doesn't just tell us it's the, again, out of the time and a half, it's not just the and a half. Okay. And there's other stipulations that box is not going to qualify for. For example, the One Big Beautiful Bill Act says that overtime, it defines overtime as anything over a 40-hour work week. Your employer might say overtime is anything over an 8-hour work day, but they may pay you overtime on a week that you didn't technically work over 40 hours. So that's why using your year-end payroll detail can be a little sketchy, can lead to a lot more work on your end. So box 14 is your best bet. And if that doesn't exist, request an overtime summary report from your employer. Remembering that there is a max of $25,000 that you can take as this deduction. Another thing is that there is an income threshold, meaning if you make too much, they're going to start, that $25,000 max is going to start decreasing and eventually hit zero. So the next item in the One Big Beautiful Bill Act that is on Schedule 1A is no tax on tips. And I'm sure you've heard that headline as well. So let's talk about what that actually means. So again, this is saying that there's certain tip income that can be deducted from your income tax, when you calculate your income tax on this new Schedule 1A. It does not mean that tips disappear. It does not mean you stop reporting tips. You still got to report them. Wink, wink. I know we're going to come from an honest accounting point of view and say all tips are reported and everything is kosher, right? So what this means is that properly reported and properly documented tip income can now qualify for deduction treatment on this new Schedule 1. A lot of the same qualifications and limitations that we talked about on overtime on tips or overtime on, tax on overtime applies to tips as well, in that there's a $25,000 threshold, which could come into play with tips, probably more likely than in the overtime, but some of us may very well receive more than $25,000 of our income via tips. And it's also income tested, meaning when you make over a certain amount, they're going to start reducing that $25,000 max down till eventually it hits zero. So if you make too much, you may not qualify for this deduction any longer. So where is it going to be reported? If you're a W-2 employee, again, the tips have to be reported by your employer. And they are going to typically appear on box 7 of your W-2. And sometimes you get an additional supporting statement that shows your tips instead. But all the clients we've done so far, box 7 of your W-2 shows your tip amount. And that is the amount that qualifies. for this deduction. Without telling you to break the law, I am going to tell you that if for some reason you are receiving tips that are not showing up on your W-2, you're not going to want to file or report those on here because you're not paying tax on those. If they're not being reported on your W-2 and you're not reporting them on your 1040, those are the only wages that apply for that qualify for this deduction. All right. You have to report the tips in order to deduct them from your income. If you're self-employed and you report income on a Schedule C, meaning you're a 1099 contractor, anything like that, your tip income has got to be separately tracked from your other income, your other revenue. So that means your books have to clearly distinguish tip income from any other revenue you bring in. And that may mean you have POS reports or transaction logs that support that. All right. The IRS also made a nice list of industries and professions that do qualify for this. Accountants, lawyers, doctors, not on it, because we are not supposed to be getting our money via tips. And this is important just because we hear the joke going around like, hey, I'm going to send you an invoice and you're going to see the invoice is only $5, but there's a required tip of $500. They squash that by saying, yeah, if you don't rely on your tips for your, like that's not how you make your income, you're exempt from this deduction. So if you're a Schedule C and you do receive tips as part of the money you bring in, you want to make sure it's not buried in your gross revenue. Because if it is, it's invisible. You can't take this deduction. You want it to be separately reported, separately documented. All right, the next item on your Schedule 1A, this new Schedule 1A under the One Big Beautiful Bill Act, is the personal vehicle loan interest deduction. So this is one where I think the headlines read, car loan interest is deductible again. Guys, I've been an accountant for over 20 years, and I don't remember when car loan interest was ever deductible, but maybe we're going back even farther than me. But all that to say that yes, but in very, very, very specific situations. So this new law allows certain personal vehicle loan interest to be deducted under this new Schedule 1A. Okay, and I want to be clear that this is not business vehicle deduction. This is not mileage. This is not depreciation. This is strictly loan interest on a personal vehicle purchased. And there are some very specific ways to qualify. Okay, vehicle must be for personal use, so not a business vehicle. It must have been purchased in 2025. They go so far as to add the caveat that the loan must originate in 2025 or later. So it must be purchased and the loan must originate in 2025 or later. The vehicle must meet U.S. final assembly requirements, meaning that the final assembly was here in the U.S. How do you determine that? Well, there's plenty of websites out there that are like VIN verification numbers, where if you have your vehicle VIN number, you stick it in there and it tells you where it was final assembly happened. There are some foreign vehicles that qualify because they are assembled, final assembly is done here. You'll be surprised there are some American-made cars that do not qualify because final assembly does not happen here. So the best thing to do is stick your VIN into one of those verification websites and look it up. I would tell you, do not pay. And there are plenty of websites out there that do not make you register either. You could just put your VIN in and get that information you need. All right. And so if you do qualify, then what you're going to need, so if you did buy a vehicle for personal use in 2025 or later, the loan originated in 2025 or later, it was final assembly was done in the US, you qualify. So what do you need? Normally, when we get a tax deduction, we'd receive a tax document, right? Like for mortgage interest, we receive a 1098. In 2025, that requirement did not exist. They did not require loan or lenders to submit an official tax document stating how much interest was paid. Maybe they will in 2026, we'll see. So what you're going to need is your December statement showing the interest paid for the full year. And that's the amount that will be on the deduction, okay? So you'll see there's a lot of gates to go through to actually qualify for this, but the benefit, depending on when you bought it and how much interest you're paying, could be a decent chunk of change. So the last Schedule 1A deduction under the One Big Beautiful Bill Act that we wanted to discuss is the expanded senior deduction. And this one, like many of the others, is income tested, meaning if you make too much, you phase yourself out. But it's really simple to qualify for. If you're a taxpayer, age 65 or older by year end, so even if you didn't turn 65 till December 31st, 2025, you will still qualify for this deduction. You get an additional deduction. It is $6,000 per taxpayer. So that is $6,000 for single or $12,000 if you're married filing jointly. Like I mentioned, there are income phase outs. So that 6,000 dwindles down as you make too much, if you make over the income threshold. And that just kind of signals a lot that we see a lot in these deductions, is that many of them are becoming income tested. They're trying to make these available for low income earners because the thresholds aren't very high. For some of for one of them, it's 100,000. For some of them, it's 165,000. So it's not crazy high. So you'd be surprised that like mid-level taxpayers are phasing out of some of these deductions that we're discussing. Okay. And the reason it's important for this senior deduction is a lot of retirees assume that they're going to get this deduction, but then they don't realize that they actually have a lot of taxable income and they're over that threshold. So they use your modified adjusted gross income to calculate your eligibility. And so it's not just about age, it's about making sure your income is in the right place. So all in all, here is what I want you to understand about the One Big Beautiful Bill Act, and specifically about this new Schedule 1A. It doesn't just add deductions, right? It increases document standards and document requirements. Most of these items have income testing and thresholds, and it really does increase the need for financial clarity. So if you're self-preparing your return, you're gonna need to have proof to take these deductions. And if you're working with a tax professional, you're going to want to give them clean documentation, because strong financial decisions are built on visibility and being able to see what you qualify for.